Welcome back, everybody. It's good to have you to another real estate market update for the greater Milwaukee area, this time September 2025. I hope you're good. I hope your basement didn't get flooded. I've been in way too many flooded basements over the last few weeks. I actually made a video about some tips and tricks on how to recover and future-proof your basement for other rain events. So you can go check that out on my YouTube channel. If you're one of my past clients and I know your house and you're looking at an estimate from a contractor that looks like it might be a little bit on the high end, let's take a look at that together and see what that should be. Just reach out to me. All right, we have a lot to talk about today from the economy. We have a lot of news, a lot is going on with the labor market, with the stock market, with mortgage rates, with the Fed rate cut potentially coming in. And we're going to talk about what that could eventually mean for the housing market. There is a lot of fear mongering going on the internet. If you came here for some level-headed analytics, you came to the right place, let me tell you. There are a few concerning things, but the sky is not falling. So let's take a look at the data today. First of all, I want to get started with acknowledging something that all of us are feeling, and that is the increasing cost in basically everything. Here's a chart that shows you the last 5 years of what happened to consumer prices. Wages have gone up quite a bit, but they have not kept up with US rents and with home prices. Feel free to pause the video if you want to take a closer look at that. But that is basically the backdrop behind what's going on politically and what's going on with the economy. So I'm sure you've heard it in the news. We have seen disappointing labor numbers over the last 4 months now. August numbers came in at only 22,000. And what you need to know, I think, is the context that with the population growth, with the labor force participation, we basically need a minimum of like 80, 90,000 jobs a month being created in order to just break even. So anything that's less than 80 or 90,000, I put a red line here in the chart, is basically not great news for the job market because we're looking at a contracting economy. And take these numbers with a grain of salt because they're based on a survey, and then when they have more results a month later, they'll get corrected again. But I think after the last 4 months, I think we're seeing somewhat a little bit of a trend here. And you can also see how this is looking quite a bit different to what we've seen before. And so that's the situation there. And of course, this is getting some political attention, in particular now as of late, and especially for the housing market. And the reason behind that is that real estate represents 18% of the GDP of the US. So almost a fifth of the US economy is depending on the real estate market. So that includes anything from builders to, of course, real estate agents, but also to contractors, to moving companies, to places selling furniture and light fixtures and building materials and notaries and lawyers. Everything that's going on in the real estate is a pretty big chunk of the economy. And we have seen the real estate market contracting over the last 3 years. And of course, that has implications for the GDP and also for the affordability. We have relatively high home prices now in combination with also mortgage rates that are much higher than what we were used to 3 or 4 years ago. And that combination, of course, higher prices and higher rates creates really an affordability challenge. Obviously for buyers, but what many people are forgetting also for sellers, because they don't want to move, because they need to buy a house somewhere else, and that's going to be costing more and also having a higher mortgage rate. So they're very reluctant to put the house on the market and move, and that is really attributing to that shrinking market, to that, yeah, you can call it a housing recession because the housing market is down. And we are looking at that a little bit more detailed in just a second. But before we get there, let me just give you a quick update what's going on here locally in our Milwaukee market, which is very different what's going on in the rest or in many parts of the US. So here are the August numbers. Inventory almost 2,000 units on the market, which is the highest we have seen it this year, up 17%. Look at the numbers below. You can see it's still a very small inventory compared to historic standards, but it's better. A very contracted market. Only 1,177 units have closed. Not many people are selling. Not many people are buying. Nevertheless, the ones that are make the market move relatively fast, only 6 days on average, and prices are up. So people are still competing for real estate, 7.37% up in August, and we're at $408,000. Which is basically double of what we have seen 10 years ago. You see the number below here. What are some of the trends that I've seen? The last 2 weeks of August have been noticeably slower, probably because of the floods we have seen, but also Labor Day weekend. And that has changed. Last weekend was actually quite a bit busier. Median home prices year to date, so that's everything, all the months, all the way through August, up 6.13%. So that's a relative solid number and in line with what we have seen over the last 10 years here in Milwaukee on average. Inventory is higher than any other month. And that makes August through October every single year the best time to buy. Everybody wants to buy a house in spring. If you can avoid it, buy it in fall. Much better time being on the buying side. Selected listings are still selling competitively. That's why you're seeing the prices going up. But that's not the case for everything. I have been able to negotiate quite a bit. In one case, close to $100,000 on a deal. And that just happens when listings are sitting on the market for 30, 60 days. Buyers are gaining some leverage, and you can negotiate actually quite a bit. The trend to cash offers continues. So we're seeing people taking money out of the stock portfolio and using it buying real estate. Because they're also looking at the mortgage rates, especially where they were in the last few months closer to 7%. And they're saying, well, maybe that's a better use for my money to just use it to buy real estate. So here's a high-level picture on where we're at. I think it's always important to have, maintain that high-level overview. In green, you have the Milwaukee metro area median home prices versus red, which is the US average. Milwaukee is slowly catching up. We have a very pronounced seasonality between the summer peaks and the winter lows. This is July data, and you can see we're actually already on the way down. We're in September now. So this is what makes it a really good time to buy, softening prices, but also a lot of inventory on the market. Interesting thing is that Milwaukee has not participated in the craziness that we have seen here nationally. We've been very level-headed. I actually really liked it about the Midwest here. And now that the national market is kind of flatlining and almost not going up anymore, kind of sideways trending, the trend here in Milwaukee continues. We're about to catch up with the national market in the next, few years. I think we will be there. Milwaukee is not a below average city, so that's the reason why real estate prices probably are going to be trending towards the national average. So people are always talking on the internet about a real estate market crash, and what everybody associates with that is a crash in prices, as we have seen that back in 2008, 2009. The situation couldn't be more different, so forget that. There is no indication that we're anywhere close of being in danger of losing prices. But what this chart is showing you is how the market has contracted. A recession is a reduction in economic activity. If GDP is down 3%, that's a huge catastrophe. If you look at the Milwaukee real estate market, we are down from here. Basically, the last 3 years, we are down 25%. And that has to do with mortgage rates. When you correlate these two charts, it's pretty clear. Rates went from 3 to almost 7%, and that really cut the knees out of underneath the market. And that has a lot of implications for the local economy, because there's a lot of other related economic activities that are also hinging on real estate. So we are in the middle already of a real estate crash, real estate recession, a significant one, minus 25% down. That's not a small number. But what it's not happening is it's not a real estate price crash. That is what people always associate, and that's totally not what is happening. Let's take a look at inventory. So these are the last 12 months. The blue line here is total inventory. If you're a home buyer right now in the Milwaukee area, this is what you see. So more choices than we ever had this year. And the red line is what's coming new on the market every month. And that's still relatively solid, and it will be for September and October. So you have a fair amount of choices out there. And the competitiveness is going down. Here you have the list to sale price ratio. That's basically telling you how much people are negotiating, either up or down. And we have been in the competitive zone all year in spring, summer. And as expected, same pattern as we've seen the last few years. We are coming down nicely here, right on track to the expectations. Now at 101.5%. So people on average are still paying 1.5% over list price. but that competitiveness is coming down. And keep in mind, this is the August number, which are basically deals that were made in July. So September and October, a lot less competitive than the first half of the year. But the local real estate market is not the same as the national market. Let's take a look on how prices have developed since the 2022 peak nationally. Blue is where prices have gone up, red is where prices have gone down. Very clear trend here. Wisconsin is very blue here. Prices have gone up in the entire Great Lakes region here. The Midwest has been doing really well, and also the Northeast. As you go down the eastern seaboard, markets are softening here. Florida has a huge oversupply on condos, so that market is coming down. Prices are softening there, so they're really coming down. Homes are on the market for half a year, for a year, and then sellers, of course, are getting a lot more negotiable than with our median 6 days on market here. A very different situation. And of course, Alabama, Louisiana, Texas here has vastly overbuilt. They have way too much inventory. And now the prices are softening here, of course. And then also Arizona, Nevada, California, same thing. So it's really these markets here. And when you are looking for the reasons why is this happening, just look at inventory. Inventory is really what's driving prices up or down. And all these brown shaded or gold shaded areas here, this is where inventory is lower than it was before 2019. So Chicago is down 60%. Milwaukee, I don't have a number here, but similar color here. And also the Northeast, very tight on inventory. Buyers have to compete, and that is driving up prices. Good old economic 101, supply and demand. And if you look on the South here, Florida in big trouble. Huge amount of inventory, Texas. So inventory and prices, you see the total one-to-one correlation. This is really what's happening, and this is what's impacting prices. The other thing that is driving prices is actually mortgage rates, and we have some good, interesting news here. We have seen rates drop very sharply last week. I actually have a lender in Milwaukee, a local bank that offered 5.8% as of yesterday. And so that is a big change of where we have been. And consider this your reminder to maybe refinance. So if you're currently sitting on a 7% plus mortgage rate, then these rates are definitely worth refinancing and cutting down your monthly expense on your housing. So usually the rule of thumb is if you got a full percent, sometimes 3/4% is enough that you can actually break even with the refinancing. And no surprise, Mortgage Banker Association came out this morning and said refinance applications have hit a 12 months high. So don't wait, don't procrastinate. If you're sitting on a high interest rate mortgage, 7% or up, definitely talk to your lender or talk to me about refinancing. Ask me where you should go. Why is this happening? A lot of people think this is because of the Fed is cutting rates. Well, that hasn't happened yet, but mortgage rates are down. So why is this happening? It's because mortgage rates are following the bond market, specifically the 10-year US Treasury note. Global investors are expecting an economic slowdown. So I don't know if you want to call it a recession, but it's just an economic slowdown that we're seeing, and that's not a US problem. That is across the Western world. We're seeing it when you look at the data in Europe or Japan, exact same issue here. The 10-year Treasury is really the benchmark for mortgage-backed securities. So when you take out a mortgage, that gets bundled and then sold off, and large-scale investors are saying, well, I can buy a US government bond for 10 years and get about 4% currently on that, or I can invest into mortgage-backed securities and get a little bit more, usually about 2% more. We'll talk about that in a second. So the Fed is expected to cut rates. Jerome Powell will announce that, I think, on September 16th. But most people really tend to be, and it's shocking me how many people on the internet are talking about Fed rates and mortgage rates as being the same thing. They're not. If the Fed is cutting rates, that does not mean that mortgage rates are going down. In fact, last year when the Fed was cutting rates, mortgage rates actually went up as a response. So there is a real possibility that if the Fed is cutting rates next week, that we are going to see mortgage rates are going up. This is why I'm urging you, if you want to refinance, then the next couple days, call your lender and get that locked in, because this opportunity may not last. I don't have a crystal ball either on mortgage rates. Maybe it does, but there is no guarantee that lower Fed rates will mean lower mortgage rates. It's still all capital markets, and they're all somewhat tied together and connected, and Trump is putting a lot of pressure on Jerome Powell to lower rates. And it's probably going to happen, but there is no telling, at least for me, on how the bond market is going to react to that. And here you have that correlation. In yellow, the lower line, this is the 10-year Treasury bond. And then in blue, you have the 30-year fixed rate mortgage. And they have a certain spread. And that spread over the last years has been relatively wide. That is a risk premium that the market is charging for mortgages. And it has been a lot lower. Look here, we're at 1.38 and now we're currently at 2.28. It's getting better. We were already higher. And if that spread is coming down, that also means mortgage rates are coming down. We could be theoretically at 5.5 if we would have a smaller spread. But so this is the backstory that you need to know the next time somebody's telling you the Fed is cutting rate and that gets mortgage rates down. Now you know better. This is really how mortgage rates are working. Why is inventory an issue? Why do we have a housing shortage in the US? Again, we have to zoom out here, big picture over the last 50 years. You can see that here are 15 years where we have underbuilt. So we have about 85 million homes in the US, but we need to build at least 1 million every year just to keep up with growing population. And we're also losing some houses to floods and fires and just old age, so they're dropping out. So we need to build, like, if a maintenance minimum that we need to do is 1 million, and we have underbuilt here. So we have a shortage of around 4, 5, 6 million homes, depending whose statistics you believe. So what would really need to happen is that we would need to overproduce for a few years in order to, get out of the hole that we dug ourselves in. And actually the opposite is happening. So when you look at the last 5 years, we have just hit a new 5-year low in single-family home starting permits. So there are a lot of factors into this, higher interest rates, of course, but there's also labor shortage. It's very hard to get carpenters that are under 55 or 60 years old. Young people are just not going into the trades. I just realized I forgot to mention one thing when I recorded the video before. So the housing shortage that we have in the US, 4 to 5 million units, is a problem that does not have a quick solution. In order to bring up housing production capacity, we need new zoning laws, we need to develop the land, subdivide it, builders need to ramp up capacity, bring more labor on board, train more tradespeople. All that takes time. So we're talking several years, if not a decade, to really dig out from that housing shortage. The quicker solution to this current affordability issue would be to lower mortgage rates. There is a path to that because the administration can instruct either the Federal Reserve or the Treasury Department to start buying mortgage-backed securities, and that would bring mortgage rates down. But what lower mortgage rates would also do, it will bring a lot more buyers back into the market, and that in turn will create more upward pressure on prices. So lower mortgage rates always translate into upward pressure on pricing, meaning house prices would be going up even more than they already are. All right, back to the builders. The big builders like Lennar, D.R. Horton, we don't have them locally here, but they're also struggling with the situation in the South. So that's the reason why we are seeing fewer building permits. And that impacts a lot of other industries. I look at a lot of data. I just want to show you one here, and that is lumber prices. They have hit a new 12-month low. So that's a whole industry that is hinged on the housing market. And importers have stocked up. They bought a lot of lumber from Canada. When the tariffs were announced, they wanted to bring inventory in before the tariffs hit. And so they really filled up the inventory, spent a lot of their cash. And now they're facing falling demand, and so they're undercutting each other on price. This is why lumber prices are down to $526. And just a few years ago, I was telling you that we're looking at lumber prices over $1,700. So that's a huge change that we're seeing here. And it's very difficult for the big lumber yards to really navigate this environment. So all these things are factoring into the housing market. We'll have to keep an eye on it and see how that shakes out over the next year. What I can tell you is what we're probably going to see over the next few weeks in the Milwaukee area. That's relatively predictable. September has started with more activity, especially the last weekend. We've gotten 3 accepted offers and generally have been a lot more busy. We have a few listings that are coming on the market as well. I know I'm not the only agent. If I talk to my photographers and my stagers, they're all busy. So there is more inventory coming in the next weeks. Inventory is going to increase slightly before it starts declining towards Thanksgiving and then the holiday season. Mortgage rates, I don't know. There are two lines of thought. Some people say don't wait for the Fed cut because we could see what we've seen last year. Fed is cutting rate and the bond market is responding unfavorably and we see rates going up. I don't know what to tell you, but sometimes it's better to have a bird in the hand than two in the bush. So if you are sitting on a high mortgage rate and you're thinking about refinancing, do it before the end of this week. Do it before the Fed rate cut. There is no telling what's going to happen after. If rates continue to fall, then great, you can refinance again, but at least lock in the lower rate that you have already seen. Seasonality, fall is always the best time to buy. I've heard it now multiple times from clients in spring that they've told me, yeah, we remember you told us in fall to act now and not in spring. We didn't understand how big the difference is. It is really massive on the level of competition, how you have to compete, how you have to waive contingencies, home inspection, compete with cash offers, all that stuff. It's really tough in spring. And if you can choose, fall is a much better time. If you're thinking about selling, the spring market is a better time to sell, but most likely you also have to buy a house. Ideally, you could sell in spring and then buy in fall. That's, of course, a strategy. There is about 5 or 6 good ways how you can strategize this and go about this if you want to have a conversation with me about your personal situation and how to best go about it. Send me an email, m.auerbach@kw.com. Or you can also give me a call. My number is here on the screen. Just don't be surprised if I actually pick up because that's what I do. And that's all I had for you today. Thank you very much for watching and I'll see you at the next one.